In this video, we will try to learn what is profit and loss account. So I will mention it as P and L account. Okay, so I'm still grappling to get used to writing with this pen. So my handwriting is still not that clear. So P and L account. Okay, now typically P&L account begins with profit and loss account begins with the mention of revenue. So basically P&L account is all about how the company did in the current financial year, and it shows how much money was made in terms of collection from the clients, what were the costs, nature of the cost, what charges to be charged for the assets that the company utilizes, taxes the company pays, and what the company is left with at the end of financial year in terms of profit or losses, if any. So it begins with revenue less direct cost. Now direct cost will typically include costs like labor cost, fuel, raw material, purchases made, if any, etc. After direct cost, you are left with what is called as gross profit. From gross profit, you will deduct general and administration expenses and selling and marketing expenses. Now the sequence is normally the reverse. Selling and marketing is mentioned first and general administration expenses are mentioned later. So selling and marketing expenses will include first of all salaries of sales executives, marketing people, and advertising expenses, communication expenses, and other kind of expenses. And general administration expenses would include salaries of the staff which manages general administration of the company and related items which fall under office management, managing the entire operations, back end, support, etc. So these costs are typically called as operating cost. Many times depreciation is also considered a part of operating cost, but predominantly direct cost, general administration cost, and selling and marketing costs are considered as operating costs. These are the costs required for the smooth operations of the company. So after this, you are left with a predominantly used profitability measure of any company, which is EBITDA. Okay, many times it is also referred as EBITDA. It means earnings before interest expenses, tax expenses, and depreciation and amortization. Now EBITDA is considered as one of the key ratios because after that you would see that depreciation and amortization may change across companies, even the companies in the same sector, because of different policies adopted by different companies for depreciation and amortization. So from EBITDA, you further deduct the charges on your fixed assets, or I would say tangible assets, which is depreciation, and intangible assets, which is amortization. So after you deduct this, you are left with EBIT. Now this EBIT is also referred to as operating profit. From EBIT, you would then deduct interest expenses, then add other income items. Then there is a possibility that there is some extraordinary gain, so I would write as extraordinary income, or there is some extraordinary expenses which will lead to profit before tax. From this profit before tax, you would deduct taxes and you would be left with profit after tax. Now from profit after tax, if the company and the board of directors choose to give the dividends, they will give dividends and you would be left with retained profit. Now this retained profit is carried forward to the balance sheet of the company under reserves and surplus. Now this is a broader structure of the profit and loss account of the company. Then there are different ways it is represented. This particular format is called as vertical format. It is easier to understand. Then there is debit credit format, which is typically a horizontal format, and there are different names with which different formats have been made for different purposes, but mostly for equity analysis purpose this vertical format is referred generally. That's it for now. Thank you.